Hello and welcome to another episode of the Opus WealthStyle podcast. We're here for episode 2, or part 2, I should say, of our conversation with Bobby Samuelson. Bobby, again, thanks so much for being on the podcast today. We wanted to kind of shift gears from our conversation in part 1 around whole life insurance and permanent coverage to sort of one of the more popular products in the insurance space that we've seen pop up over the, I would say for me at least, last 7 or 8 years around indexed universal life insurance. I find it to be one of the most misunderstood and sort of advertised ones in the social media space these days. So before we start, can you just explain to the audience a little bit about what IUL is, how it works, kind of why do you think it's been so popular? And we can dive into a little bit more about the actual utility of it in a minute.
Yeah. So it's amazing to me how social media has turned this thing from, into this phenomenon almost. So you're starting at the right place, which is, look, how does this thing actually work? And I think there's this huge gap between how it actually works and how people are describing it.
Yeah.
And that's trouble no matter what, anything we're talking about, if someone's describing it one way and it's actually working another way, that's a problem. We have seen that happen a lot of times in the insurance world, kind of back over the years, where insurance is portrayed a certain way, and then it actually works a different way. And what you always end up with is, our class action lawsuits, very disappointed clients, and sort of this wreckage of destruction. And so in my mind, if you're pitching insurance, you need to make sure your descriptions are very, very close to how the policy actually works. Like those two things should be very much lined up. And look, it's not whole life. There are people who sell it this way when it actually works this way. I mean, you see this everywhere, but I think with IUL, the gap is probably the biggest. So let me just sort of explain it back from the basics. So every permanent life insurance product, like we said in the last episode or last part, every permanent life insurance policy works the same way. Premium in, charges out, whatever's left over is invested, and the carrier credits you interest on that, and that creates your cash value. And ultimately, your cash value goes to support your death benefit. So that's every permanent life insurance policy works that way. With whole life, you're paying premium, you've got policy charges, carrier invests the money, you're a participating policyholder, so that money is going to come back to you in the form of a dividend. That creates your cash value. With universal life, which is a flexible premium product, so you can decide to pay whatever you want, right? As long as the cash value is greater than 0, that policy stays in force. So whole life, you have to pay the premium to keep it in force. With UL, you can pick whatever premium you want. You can shoot yourself in the foot if you want to and only fund the policy for 10 years, or you can keep it for your whole life, however you want to do it. Same deal, premium in, charges out, whatever's left over earns interest, you get cash value. With variable UL, which I own, big fan of this product category, pay premium, charges come out, you invest the money in funds, mutual funds. Mutual funds have investment gains and losses.
Yep.
That creates cash value, policy stays in force. So what's indexed UL? Well, all indexed UL is a permanent policy. That's a flexible premium contract where you pay premium, charges come out, but instead of the carrier crediting you interest, they take the interest that they would have credited you in a universal life policy. They go to investment banks, they buy options. So these are equity options, on the S&P 500 index strategies, okay? They take the earnings from the options, they pay it to you in the form of index credits, and that's what you earn on your cash value. So at its heart, and I think this is where a lot of the confusion comes in with indexed UL, at its heart, this is an options product. And here's the problem. Very, very, very few retail investors understand options.
Yep.
Very, very few actuaries at insurance companies understand options. The options world is its own very weird, sort of bizarre place. And so what I think we've seen in the last few years, and the reason why the gap is so big between how the product is described and how it actually works, is because this is actually an options strategy. And options, which are a way to get exposure to equities without actually buying the equities, you can make any kind of crazy optical illusion with options that you want to. And so the way index UL is typically pitched is this idea that you can get exposure to the market without actually investing in the market, where you have guaranteed downside protection. So you can't get a negative credit. You can only get positive credits up to a certain limit, and the carrier can change that limit at will. They call it a cap. So you have a floor of 0 and a cap that moves around at the carrier's discretion. And the way the cap moves is as the price of options change, and the price of options changed every second, that will change what the carrier can offer you in terms of your cap. And so you have people out there basically saying you can get equity returns with no risk. And that's what you see in social media is you get downside protection with upside potential, exposure to the S&P 500 with no risk, and historical performance of 8%. Even though this product hasn't been around long enough to actually have any historical performance, they're using hypothetical back-tested performance, basically saying, had we done this strategy since the 1950s, you would have earned 8%. And so that's kind of the way it gets pitched. And so it gets pitched as a product that has the safety of whole life with the upside of VUL.
Yep.
Right. This kind of magical products. So here's my joke on that. So I'm a car guy. All things go back to cars at some point for me. And so imagine you go to the dealership and someone says, "Let me show you a picture of this car. You're not going to believe this car." All right. This is a car that drives like a Ferrari. All right. And it tows and hauls like an F-250. All right. So this has got it all, right? Drives like a Ferrari, hauls like an F-250. What's not to love? And customers, God, it's so great. This is awesome. I don't even need to see it. I'm just going to sign right here. You told me about it. You said it drives like a Ferrari, hauls like an F-250. I'm in. Sign the contract. They hand you the keys. You go outside, and it's a Chevy. It's a Chevy El Camino sitting there. Okay, well, that doesn't drive like a Ferrari, and it doesn't haul like an F-250. All right. If you want a Ferrari, you got to buy a Ferrari, and if you want an F-250, you got to buy an F-250. An El Camino is a sham substitute for those two things.
If you don't know what an El Camino is, look it up. It's
part car, part truck doesn't do the unit particularly well. Okay,
right.
But here's the thing: there's a natural market for El Caminos. El Caminos were popular. I would argue that I drive the modern equivalent of an El Camino. I have a Rivian, which is an EV that goes 0 to 60 in 3 seconds, but it'll never haul like an F-250. Okay, so there's a real market here for this kind of in-between solution, and this idea of downside protection, upside potential has real applicability. But don't mischaracterize it. It is not as safe as a whole life policy. You can still lose money in an IUL. Yep. Every time you get a 0% credit, your policy values actually go down because of policy charges. And it'll never perform on the upside like a VUL where you can actually buy mutual funds because you're capped out. And over the last 10 years, we've seen caps come down like crazy to where policies that had 17% caps in 2009 currently have 7.25% caps. That completely changes the risk profile of the product.
Those illustrate a little differently.
What'd you say?
I said, I bet those illustrate a little differently
now. Oh yeah, it's carnage right now, honestly. And so, so that's the dynamic on IUL. Again, I think social media has gone crazy over it because they think it gives you equity performance with no risk. And by the way, you don't have to be a registered rep to sell it. So, for customers who don't know, you've got to have certain licenses if you want to sell mutual funds or registered products like variable annuities or variable life insurance. If you're just an insurance licensed agent, you can sell indexed UL and market it. Not supposed to, but everybody does. You market it as a way to get access to equities. Of course, that's not actually what's going on, right? You're buying the insurance company's general account. They are buying options. They're not even buying the equities. They're buying options, and then passing some of that return, hopefully all of it, back to you in the form of these index credits.
Yep.
So that's why I think the gap is so big on IUL between, again, imagine the description of an El Camino and then imagine actually seeing an El Camino. The gap could be very big, and I think that's kind of what's going on.
And when you've looked at the illustrations, right? So one of the issues that we've seen in sort of the marketplace is how the product has been illustrated, right? Or how the insurance companies are able to illustrate the products, and then actually what we've seen come to fruition are sort of, almost like oceans apart, I feel like. So, can you just talk a little bit about that? I know it might be getting a little bit technical, but I think for the listening audience, it's important part of this is important to just understand what is being discussed and then what the reality might actually look like.
Yeah. So the main thing, again, take a step back. What is a life insurance illustration? Why do they exist? So we're a little bit unique in that because we're selling these long-term contracts, people need to understand what they're buying and the benefits they're getting. And so it's hard to explain the benefit of a whole life policy or UL or an IUL or VUL without being able to say, hey, if you pay this premium, here's what happens over time in terms of the mechanics of the policy. Again, premium paid, charges come out, credits come in, you have cash value. Cash value needs to support the death benefit. So every year every month, really, you have this interaction of, premiums being paid, if so, charges coming out, credits coming in, and you need to kind of demonstrate to people, this is how this thing actually works over the next 20, 30, 40 years. So an illustration is designed to explain to a customer how an insurance policy works. That's what an illustration is for. The problem is you put an illustration down in front of someone without telling them that that's what this is for. And what it looks like instead is a projection of future values. So you see these values going out for the next 40 years. And so the way a lot of agents position this is they say, look at the illustration. These are the projected values. No, 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 no. These are not projected values. This is a demonstration of how it works.
Mm-hmm.
The chance of you getting this illustration is literally zero. Okay, there's no way that this is actually what's going to happen to your policy because interest rates are going to move around. All sorts of stuff's going to change. So first of all, at the heart of it is the misuse of illustrations and agents using illustrations as financial projections, which is completely inappropriate. There's been all sorts of actuarial task force put together on this, talking about how inappropriate this is. The problem is carriers are addicted to it because if you can show a good enough illustration, then you can sell a lot of life insurance because clients get really excited about the idea of earning 6, 7, 8% on a product, even though that was never the intent of the illustration. That's not actually what's going to happen. It's just that that's the way the illustration works. So every policy has its own kind of illustration mechanisms. IUL is completely different. I actually helped draft the IUL regulation for illustrations. It's been through 3 rounds now because carriers keep finding loopholes in it that make their products illustrate better. But basically what separates IUL from like a whole life policy is in whole life, if you illustrate a whole life policy, you have to use the current dividend interest rate. So Guardian declares a dividend interest rate. That is what they use to show the illustration, the values on the illustration. Yep. Not a projection, but it's a demonstration. Now, what's true about that is that if Guardian never changed the dividend interest rate, then that illustration would exactly match what the client gets. But Guardian is, of course, going to change the dividend interest rate, and you want them to over time in order to reflect what their earnings are on their portfolio. Okay. With IUL, because there's no crediting rate, because they don't credit any fixed interest like you do in a whole life or UL policy, they had this index interest. They had to come up with another way to illustrate it. And so basically what they said was, okay, well, we've got this floor and this cap. Let's take that floor and the cap and apply it to historical equity return data. So we're going to apply it on the S&P 500. Let's say we'll apply it to the S&P 500 going back 66 years. And there's a whole reason why it's 66 years, but basically back 66 years. So if you've got a 0% floor and a 10% cap, we're basically just going to assume that you would own this IUL since 1955 or so, or 1958 or so these days, with a 0% floor and a 10% cap. And we're going to take the average of all those returns, and that's how we're going to illustrate the policy. So we're not going to illustrate, even if the carrier is, let's say it costs the carrier 5% to buy that 10% cap. That's what they're actually spending with the investment banks to buy the option. They're not going to illustrate it at 5%. They're going to illustrate it at 6.5% or 6.2% or 6% based on what that cap looked like if you'd applied it back to historical data. And so that's the difference. And so what always happens is IUL, as a result, always illustrates more aggressively than an otherwise identical universal life policy. The only difference between those two is the carrier pays the interest directly to the policyholder in the form of a UL. And with IUL, they pay the interest to the investment bank and then credit the indexed interest to the policyholder. From a carrier standpoint, these two things are exactly the same, but they illustrate completely differently. And one illustrates much better than the other, which is part of the reason why it's been such a high growth part of the insurance business and why it's become so popular, is because it illustrates so well.
Gotcha. And so if you were a consumer, right, and you were considering IUL, and again, I'm not saying that it doesn't fit some need, right? There's always a product that fits for some particular person, right? So if you were considering IUL, what are the illustrations or the iterations of the options that you would want to have the insurance broker show you to evaluate the contract?
Yeah. So first thing is, good rule of thumb is run it at about 70% of the maximum rate. So if they're showing you 6, ask for 4.5 or something, somewhere around there. Always run it lower. Remember, I'd say to any client, these are not projections. These are demonstrations.
Yep.
And so you should ask for as many illustrations as you want to understand what happens in different scenarios based on, again, the same math: premium in, charges out, interest credits, cash value. So if you have less interest credits and you have premium and policy charges, that cash value may lapse earlier, and you want to know that. So run it at lower illustrated rates. That's kind of number one. And so honestly, if here's the simple kind of Occam's razor, sort of approach here. If you're willing to buy it, if you're willing to buy it when it illustrates at 4.5%, you're probably safe. If you only want it when you illustrate it at 6%, you got a problem.
Yeah.
And that's going to become an issue. And here's the basic math, right? So think about this idea of taking the cap and applying it to historical equity data. Well, when you do that, you make several assumptions. One assumption is that the cap never changes, and the cap will change.
Yep.
The cap will change a lot more than a dividend will change in a whole life policy, because a DIR is set annually. Okay, a crediting rate in a UL is usually set annually, because portfolio rates at life insurance companies are slow to move. Like, interest rates have come up a lot. Portfolio rates at insurance companies have not come up as much because they've got old bonds blending with new bonds. In the long run, it's all going to wash out, but in the short run, they're slow to move. Options change all the time, and option prices have actually been going up a lot, which has been pushing cap prices or caps down.
Right.
That's what you would expect. In fact, I mean, every month the carrier, when they sweep all these policies use monthly sweep dates, so they roll money into the index strategies every month on the 15th of the month. Every month you should see a different cap, because market prices for options are moving around. So number one is, you're assuming the cap never changes. We know the cap's going to change. We know the cap's probably going to come down from where it has been, could go up, whatever. We'll have to see how it goes. But in the past 10 years, it's come down precipitously. So first of all, if you run it at the maximum rate and you don't ask any questions, you're assuming the cap never changes. You're assuming that future equity performance is the same as past equity performance. So here's how I'd phrase this to a client. When you run an IUL at the maximum illustrated rate, you are not only assuming the cap never changes, but you are also assuming that future equity returns have the same exact profile as past equity returns. Mm-hmm. So the same average return and the same way that they get to the average return. So what we've seen in the last 50 years is lots of gradual ups, sharp downs, lots of gradual ups, sharp down. That's exactly what you want for an IUL, because it's 1 year of a zero and a bunch of years of positive credits. If you have a different return pattern, even if you have the same average, it's going to be a different result. So here's a question I always ask, right? What do you use in your kind of financial planning for long-term equity returns, right? As a client, what do you think is reasonable? Or as an advisor considering IUL, what do you think is reasonable? Usually I hear numbers, 4% on the low end, 6%, 8%, maybe a 10%.
Yeah.
Every now and then. But typically, I'm sure you guys are in the same boat, somewhere between 6 and 8, somewhere around there. Okay. If you go back and look historically at average S&P 500 returns in this sample period, the average return with dividends is 12.5%. So if you run that IUL at the maximum illustrated rate, that is the same thing as assuming a 12.5% return in your equity allocation elsewhere in your financial plan. So if you're not comfortable running 12.5% returns in your other parts of your financial plan, then you can't run this IUL at the maximum illustrated rate, because it uses historical data that would tell you that you should do your plan at 12.5%, and you've decided that's too high. So you need to adjust your IUL rate down in the same way that you adjust your. Does that make sense?
Yep.
Mm-hmm. Okay. So the other piece of that is back to the El Camino analogy. If you really think equities are going to do 12.5%, you don't want to be an IUL. You want to buy a VUL where you can actually invest in equities. So again, if you really think that's what's going to happen, you would never buy this product. All right. And the last piece, which I think is also really important. So again, the maximum rate, which is what most people on social media show, assumes cap never changes, assumes equity returns of, let's say, 12.5%, and they assume the maximum rate is based on the average of all these 25-year periods within that 66 years. The average. So what that means is about half the time, it's not quite exact, but about half the time you would have done better, and about half the time you would have done worse. So the question I ask clients is, and again, I don't sell insurance. So when I say clients, I mean like people who find me on the internet and they want to know what to do with their IUL policy. Mm-hmm. I say, look, what is your acceptable percentage chance of failure? How much risk, what is your acceptable percentage chance of failure? And they always give me the same answer. And what do you think that answer is?
Zero.
Zero.
Yeah.
Okay. So right now, your illustrated rate, Mr. Client, is calibrated to a 50-50 chance of failure, assuming 12.5% returns and assuming caps never change. That's where you are right now. So if you're telling me that you have a 0% chance of failure, well, then I got to illustrate a much lower illustrated rate. I've got to illustrate 4%, or 3.5%, or whatever it is, to make sure that no matter what happens in the equity markets, you are going to end up on the right side of that trade. And so you got to lower that illustrated rate down. By the time you're done doing that, putting that level of conservatism in, again, going back to the El Camino analogy, right? You would have rather had a whole life policy.
Yep. Yeah.
So that's the weird kind of psychology of IUL, is there's a real intuitive appeal to downside protection, upside potential.
Of course.
But if you actually go through the belief structures of what it takes to think that IUL is a better solution than, for example, what I have, which is whole life for stability and VUL for upside, it's kind of a weird fit. I think there is a place. I think there are some clients who want it all in one package. My VUL, for example, has indexed accounts in it.
Mm-hmm.
I think that's a great solution for me in certain situations if that's what I want to use. Like there's a real role here. But if you just think long-term and long-term belief structures, most people are going to end up kind of saying, I really believe in equities. I want to go VUL, or I'm using this for safety, stability, fixed income alternative, conservatism, right? Protect families, preserve capital, provide stability. Whole life does that better than IUL.
Yep. Sorry, go ahead.
No, go ahead.
No, it was, the last part of it for me, when I think about VUL or I think about whole life insurance, around the premiums, right? Like you have to input money into these policies, but what happens if you miss one in an IUL, right? What happens if the market's not doing so well? And listen, Bobby or, Evan, hey, listen, I can't fund my premium for 6 months or a year.
Yep.
How does that impact it, right? And I don't think, yeah.
Yeah, so that's actually a spot where a lot of IUL promoters will rightly say that IUL is more flexible than whole life. So with whole life, that premium has to get paid. Now, that's the high level talking point. We all know in the space that if you've got a whole life policy and your premium is $10,000 a year and you have $100,000 of cash value and you don't pay a premium, you can withdraw from the policy to pay the premium. You can borrow money from the policy to pay the premium. You can use dividends to pay the premium if your dividends are big enough. You actually have a lot of flexibility, but that premium has to be paid. With IUL, they don't care how much money. I mean, it's a flexible premium. So if you skip a premium, you think back to the original mechanics here, premium in, charges out, earns interest, cash value. We're just taking away the first part of that, which means you've got cash value that's here, right? Minus charges plus interest equals cash value at the end of the year.
Yep.
And so in some ways, it's actually, I would say IUL is more flexible from a top line standpoint than whole life. But a lot of people, again, IUL promoters will say, oh, well, that's why you don't want to have whole life. Well, wait a second. Whole life is 95% as flexible as IUL, as long as you've built up cash value. And whole life naturally always builds up cash value because that's the premium. It's set to build up cash value. And so I think that's kind of one of the knocks on whole life that I don't think is very fair. I think there are some situations where that flexibility of IUL really shows.
Sure.
But I don't think it's a reason to choose IUL over whole life. If you understand the flexibility in whole life, the two are very comparable as long as you know how to use it.
Yeah. As we kind of wrap up this conversation, are there any things in particular that are consistent parts of your conversation around IUL that you really want to make sure that the kind of listening audience takes away if and when they come across it?
Yeah, I think the main thing is if it looks too good to be true, it probably is. And again, I mean, I can describe to you what an El Camino sounds like in theory. And then I can now, we're 15 years really into the rise of IUL, and I can tell you what an El Camino actually looks like in practice. And by the way, some IULs have performed incredibly well. So I want to be clear about that too.
Yep.
Think about the last, 15 years. Equity returns up until last year were phenomenal. 14% price returns, 16% total returns since 2009. Caps in IUL were very high back then. 14, 15% caps were the norm. So I've seen plenty of IUL policies in the last 10 years have done 7 or 8%.
Yep.
Think about what had to happen for them to earn 7 or 8%. They've got caps that were 15%, and the equity market was ripping at 14% price returns. Unless you think that's going to happen in the future, you're not going to see the stuff in the past. So I think a lot of IUL promoters are out there saying, yeah, but IUL has been so successful for the last 10 years. And my joke is, yeah, but we've been in the honeymoon phase. These are 50-year contracts, and you got a great first 10 years. That's like getting married and going on your honeymoon and saying, well, we're set for life. You're about to go home, and she's going to hate that you put the dirty socks on the floor. I mean, this is the real world now. Okay. Mm-hmm. And I think that's where IUL sort of is in its life cycle. Is it's really actually under a lot of pressure. And so, but a lot of people are still promoting it as a sort of magical be all end all product. If it looks too good to be true, it probably is. And again, that El Camino thing, I really think it's a funny joke, but it's actually a really good analogy, which is, what are you trying to do? If you want upside, go VUL. If you want downside protection, go whole life.
Yep.
If you want something in between in a package, IUL can be an option. But if you can get an indexed account in a VUL policy, or even like what Guardian has, an indexed account in a whole life contract, why do you need a standalone IUL? So you lock yourself in. So anyway, that's what I would tell people is just be skeptical. I said it on the end of the whole life podcast, that the last conversation we had, the more you dig into whole life, the more you're going to believe in the structure. I think the opposite might actually be true for IUL. The more you dig in, the more you realize, not that it doesn't have value, not that it doesn't have a place, but that it's not what it's being promoted as. And so if you see one and you have the license to dig in, you have the license to ask questions, you have the license to push and to understand, and don't buy anything you can't understand. Yeah. And really understanding IUL is actually tough. It's a lot harder than understanding whole life. Yeah. But if you don't feel like you fully get it, please don't do it.
Yeah. Listen, this has been incredibly valuable. Bobby, we really, really appreciate the time. Where, if the listening audience wanted to find out more about you or to follow, the consulting work that you're doing, where can they find out, more about you?
Yes. I mostly work with insurance professionals. I probably once a month get somebody on the line who finds me randomly. But I do have kind of a standing offer for any sort of non-insurance person. So I write a newsletter called the Life Product Review. It's a technical newsletter for insurance professionals. It is not for consumers, but I've probably got 50 consumers that subscribe to it, and I give free subscriptions to consumers. So if you're an attorney even, or a CPA or whoever, right, or even just a person who runs a manufacturing business and you want to know more about life insurance, you can subscribe to my newsletter. Heaven help you. You're going to hate it before too long because it's a lot of industry stuff. But it is really the only independent publication in the life insurance world covering life insurance product. It's called the Life Product Review. There's a little info thing if you want to drop your name in there. That's how I usually get people asking for subscriptions. Or obviously, Iván, they can email you and you can send them my way. So
Awesome. Well, Bobby, again, we really, really appreciate you coming on. This has been incredibly valuable for us. I know the listening audience loves it. And to you, the listening audience, thanks for tuning in. We'll be sure to click subscribe below to be notified when our next podcast episode comes out. But again, Bobby, we really appreciate you.
You bet. Thanks for having me.
Thanks, guys.
Thanks, Bobby.